Hi everyone, this is Aki with another tax video going over 1099-R form, which is basically reporting distributions from IRAs, retirement plans such as 401ks, pensions, annuities, insurance contracts, and so on. Now, it's important to know that you can receive this form even if you're not retired. So basically, this form reports when any kind of transaction was done, or basically distribution was done to retirement plan, or as I mentioned, pensions, annuities, and so on. And you might not necessarily be retired. You can be under 59 and a half and still receive the form. For example, maybe you had a 401k plan that the funds were distributed to you from your employer. Even though you're not retired, you would receive this form, providing information about that plan, how much of this was distributed, how much it's taxable, and so on. You should receive this form by January 31st, and if you have more than $10 of distribution. However, sometimes they can be delayed. Sometimes you can obtain the form from your payer, the broker, or your past employer. If you have not received it in the mail, maybe you have access to the account and you can pull it yourself, and so that's helpful. Now, the year would be indicated on the form, so it's important to make sure you don't get it confused with some prior year forms. They can look very similar. They can have the same amounts, especially for people who have taken required minimum distributions called RMDs. Sometimes the amount doesn't change that much from year to year. Now, this information on the left and all the information here that I have, it's a dummy information for Jane. And so this is just an example. And most of the things that we're going to go over are the typical situations that may not necessarily apply to you. And if you wanted more information, there's an irs.gov publication for I-1099-R at the bottom. The address you can find has more information, or you can contact someone that you're working with, like a specialist, tax preparer, or financial advisor. That information on the left, this is basically, who is issuing this form. And, this could be a broker, your past employer, custodial account provider. So all that information will be here, and this, as well as their TIN, which is taxpayer identification number, which is kind of like a social security for the institution or organization. Then you also have your information and your address right there. Now, it's very important to also look at this account number at the bottom left of your form, because you might have a couple of accounts from the same payer or broker or institution, and they will provide you different 1099-R if you had different distributions from these accounts. And sometimes, let's say if you have a case when you are required to have minimum distributions taken, you might have split the amounts, across the accounts, the same amount. So you might think, oh, this looks like it's the same form, but actually, if you look at the account number, it's a different account number. So it's very important to look at the account number to make sure that you're not missing a form, or you're not, just to confirm it's not a duplicate. So now let's get over to go over the other boxes. So box 1, this is the gross distribution. So gross distribution is the amount that retirement plan, pension, annuity distributed to you during the year. This will also include rollovers. So this box 1 does not indicate necessarily how much of the distribution of the total, whatever you got, is taxable. This is just saying this is the money that you've received. Now, some taxpayers say, well, I don't remember receiving this. Well, if you have indicated that you want to have direct distribution, direct deposit to your checking account or savings account, you should be able to verify that you received this as a total, because maybe you received the payment as monthly, not one sum at one time. So you want to confirm that. Now, box 2 2A, 2B, and this other box next to 2B that just doesn't have a number. It's kind of like part of 2B. Both of them are. So this is very important information. So whenever you receive 1099-R, you have to realize that sometimes that form doesn't provide 100% of the information that has to be included on your tax return. You might have additional information that may lead to how much of that gross distribution box 1 will be taxable. So box 2 says taxable amount, but that amount can be equal to box 1, could be the same, could be less than box 1, so be less amount that's taxable, could be 0. Maybe it's a rollover and none of the amount distributed in box 1 is actually taxable to you. Or it could be blank. If it's blank, that does not mean it's 0. And many times if it's blank, that means it's kind of unknown to the payer or broker or the institution. They're not sure how much of the distribution that you received is taxable, and it is on you to basically calculate and figure out how much of this is taxable. So if they not know how much of it's taxable, sometimes it's blank, box 2A, and then you have box 2B, which says taxable amount not determined, checked. That means that they don't know. So it's on you to calculate. But look at this situation we have here. We have the situation for Jane where the amount in 2A is $12,560, which is the same as box 1, the total distribution, but we have the box 2B checked. What it means is that even though the amount is in 2A, they just put it the whole maximum amount that could be taxable, but they're indicating that they're not sure, so it's on you to calculate. The reason why they started putting the number there, even if it's not determined, because when it was blank, some taxpayers or financial advisors were thinking blank means 0, but blank it does not mean 0. So what happened, people would put 0 there, thinking, okay, it's blank, so it must be 0, and then they would receive a notice from the IRS saying, wait a minute, some of this was taxable. Why did you put 0 there? You were supposed to figure it out, and now you owe us not only tax on that amount, but on top of it, penalties and interest. So just to kind of protect the taxpayers and indicate that you don't want to be unhappy later on. It could always go into your favor if you figure out the amount to be less, but just in case we're going to put the whole amount, many institutions and brokers, they put the amount and just check it for you to indicate you have to figure that out. Now, next to that 2B, we have a box that's total distribution. So this would indicate whenever, whenever the whole distribution was sent to you and the account is pretty much empty. So you could have closed the account, maybe not, but basically the balance was 0. So all the money was taken. So this would indicate it, that situation. Now, box 3, it's capital gains, but that amount is already included in 2A. So, this would not be added to 2A. How much was taxable? It should be part of the 2A box. Now, box 4 is the total withholding that you have had. So, do you have to withhold? So, if it's a direct rollover, you roll over your, retirement plan from one account to another, and it's a allowed rollover, because not all rollovers are allowed, then you shouldn't withhold because you're not taking that money yet. You're basically just moving it to another account. However, if it's not through an account that's accepted, per IRS website, let me see right here, they might have withholding, 20% withholding that's required. Let's say if the distribution was directly to you. So you didn't roll it over, but you directly just took out the money. It could be a required 20% distribution. So it's important to know that could be a possibility. If you want to have withholding, because let's say, that withholding, it depends on your situation, on your financial situation, if you need to have the withholding or not. It's always good to have it because this is a prepayment of your income tax. So if you take out too much and you withhold too much, you will get it as a refund at the end of the year. But let's say if you take a big distribution, especially if it's your first year, you didn't expect that you have all this other income from other sources, you might be short and you wish you had a withholding. Now, if you want to change it for next year, you can contact your the payer, so whoever is basically issuing this form to you, so you can make that change. Now, box 5 and box 9B, those two boxes, on box 5, it says employee contributions, designated Roth contribution on insurance premiums, and box 9 says total employee contribution. Those two boxes indicate could be cost basis, basically an after tax amount that you have contributed to your plan, whatever retirement plan you have here, that it will be after tax contribution. So this would be an amount that you shouldn't be taxed on because you already, were taxed on this amount and you contribute to this plan and then the plan grew, let's say. So that amount, so for example, we can have situation when there's, employee contribution of $5,000, the gross distribution was $10,000, then taxable amount was also $5,000. So the taxable amount plus the employee contribution amount should add up to the total gross distribution. So it's important to know that if you have basically numbers in 5 or 9B, to figure it out how much of the total gross distribution should be taxable, because not all of it should be taxable if you put after tax money into that plan. So be aware of it. Don't put blanks if you have numbers and amounts there, because if you put it in a tax software, the software will calculate for you. They might ask you some additional questions, but it's important to have that information and include that. Now, box 7, this is an important box. So box 7 is a distribution code, as well as there's a checkbox here to indicate if it's an IRA, SEP, or simple. Now, if you're a taxpayer, you might not be aware, what does that mean? What does that box 7 indicate? And there's many distribution codes, and I'll put a link in the video. But some of the typical ones are code 1 for yearly distributions, no known exception. That means you have taken money from your retirement plan yearly before 59.5, and there was no exception to the penalty, a 10% penalty that IRS may calculate for that plan because you were supposed to take it when you are ready to retire or after 59.5. Now, code 2 would indicate early distribution. So you took out money early before you were supposed to, before 59.5, and there is an exception. And I'll show you a couple of exceptions that you can have. Actually, let me go over now. So here on IRS website, this is basically showing the different exceptions, and it basically indicates the type of exception kind of like a name, then what kind of plan you have, and based on that, whether that exception applies. So for example, there's a difference between 401ks and IRAs. So let me give you an example. Let's say if you took out the money from your retirement plan for qualified higher education, if you have 401k, you could not do that. So you will not get the exception. You will have to pay the 10% penalty. But if you have IRA, you could have an exception. You would be waived the penalty of 10%. The same, like let's say here we have a home buyers up to $10,000. If you take out from retirement plan, there will be an exception if you took it out from your IRA plan versus 401k. So this is really helpful, and it's really important to do that if you do have a penalty. If this code will indicate like the yearly, like code 1, yearly no exception, to double check that there's no rule that can waive that penalty. So it's really worth your time to do that. And that's why you have this box next to it indicating that it's an IRA or not, because the exception can be different depending on what kind of retirement plan you had. Now we didn't go over all the... Okay, now we can have disability, that's code 3, death. Code 7 is the most frequently used code, that's basically for normal distribution. Code for death, I wanted to mention that you could have received, distribution from a plan from your spouse or family member, so that would be a code that will be used. Now, code G is also important because this is basically for direct rollover. So this should indicate that the amount, in box 1, you should also see in box 2A that 0 of it would be taxable, because code G in box 7 would tell you that, this wasn't a rollover, direct rollover. And those are like the best rollover, when you roll over directly from an institution to institution, versus if you ask the retirement plan to send you a check and then you roll over, because then the institution doesn't know where is it going. Are you going to really put that back into another plan? So if you do a direct institution to institution rollover, the company who issues you this 1099-R will know that, and they can indicate right away on the 1099-R that there should be 0 taxable amount because it's a direct rollover to another plan. So that's important. And then we have another code, J, for early Roth distribution. So that will be a 10% penalty. So you can ask yourself, if I have a Roth plan, I put in my money in the Roth plan after tax, so I'm already taxed on the money, so later on I am not when I take it out. Why am I getting penalty? Because there are some rules on when you can take out money from a Roth as well. On number 9A, so this is indicating percentage of distribution. So you can say, what does that mean? So in a case, let's say it's a death benefit, and maybe the amount of distribution was split among the children or what have you, then might indicate that you received maybe from the total distribution 20%. So this would kind of indicate how much of the total distribution was distributed to you directly. Now, boxes 14 and 16. So these boxes are state information on withholding and how much of the state distribution is considered state distribution. Now, sometimes taxpayers have this blank and then they think, that means none of it's taxable in my state, I don't even have to enter. So most tax softwares, they will directly move the information from the federal return to state, but some people, might just do the state, which, I don't advise it. I advise to always make sure you have federal first, then state, so everything flows through correctly. But let's say this is blank, and that does not necessarily mean that none of this is taxable in your state. Some states don't tax the retirement income or Social Security income. For example, Illinois does that they actually don't tax you on retirement income, but you still have to put that in, and then the tax software will take care of it. Or also the financial advisor, tax preparer you're working with, they should do the same thing. So now one more thing, that you can have this form, and you can also receive it for qualified charitable distributions, and these would also, it might show like the total distribution here, and the taxable amount is something that you have to figure out. On one of the websites for TaxSlayer, I have this information. It basically says up to 100,000 of QCDs from an IRA can be excluded from income, and it's basically based on the information that you provide. So you would have to calculate, let's say you gave away $10,000. You had $10,000 distribution. How much of that you actually provided or gave away to charity? So that information will be put into the software. Thanks so much for watching.